Okay, so to a price action trader, the markets are a living, breathing entity. So it's just like you and I. And it's very hard to predict what it will do in the long term. And so the nature of markets and the nature of you and I are exactly the same. And that's that it's very hard to predict what the market will do in the long term, as well as what we will do in the long term, right? Okay, so keep this basic concept in mind. Let's keep going. Okay, however, there is an exception. Now, if price was right here at the current moment, although it's very hard to predict what it will do in the long term, so for example, a month from now, it's much easier to predict what price will do, say, in 1 hour from now. So, in other words, it's much easier to predict what price will do in the next step when compared to 2, 3, or 4 steps later. And that's just like you and I, right? It's much easier to predict what we will do in the next step rather than 4 steps in the future, right? Okay, so keeping both these ideas in mind, let's go on to a little bit of price action philosophy. Okay, so on this graph, on the vertical axis, we have the unpredictability scale. So the higher this is, the more unpredictable price is. Okay, on the horizontal side, we have time. So this is a 1 year span. Now, if price was right here at the current moment, basic price action philosophy states that the further in the future that we try to predict, the higher the unpredictability degree. Okay, so keeping this basic concept in mind, the price action trader does not attempt to predict what price will do in all these areas right here where the unpredictability scale is high. And instead, we simply try to predict what the market will do in the next step, where the degree of unpredictability is low. Okay, so all we do is read what price is telling us it will do in the next step. And when price gets to that next step, we predict what it will do in the next step further and simply trade accordingly. Okay, so let me explain that in a little bit more detail. Okay, so if price is right here at the current moment, the price action trader attempts to predict what price will do in the next step and trade accordingly. So if price right now is telling us that the next step is down, then we sell. And let's say price does go down. And at this point right here, if price is telling us that the next step is up, well, then we close the sell position and perhaps we buy. And price goes up. And at this point right here, if price then tells us that the next step is still up, well, then we hold this buy position, and so on and so forth. Okay, so in this way, all we attempt to do is predict what price will do in the next step. And we do not try to predict what price will do in the second, third, or fourth step in the future. It's always just the next step. Okay, so let me show you how we predict this next step at the basic level. Okay, so at the basic level, we use 3 methods to read price, predict the next step of the market. Now, first we use a bias, and a bias uses past price for analysis. Okay, then we also use lower confirmations, which uses recent price for analysis, and we use current price, which uses current price for analysis, or in other words, price right now. Okay, and these 3 methods are what allows us to read price and predict the next step of the market. Okay, so let me show you this process in more detail. All right, so first we have a bias. Now, a bias uses past price for analysis. So if the market is at this point right here, we're going to use the price in these areas right here to analyze the initial probable direction in the next step. Okay, so let's say we analyze this price right here and found that the next step of the market is up. Okay, so again, the bias gives us the initial probable direction in the next step. But as well as that, it has 2 added benefits. Now, one is that a bias allows us to make sense of price. So if you look at a chart and price is going up and down, sideways and zigzaggy, it's very hard to make any sense of this price action. Okay, but a bias gives us a context in which we could trade within. Or in other words, it gives us parameters or a framework where we can make sense of what price is doing. Okay, and those parameters in this case is at this level right here and this level right here. And both these parameters are derived from this past price analysis. Okay, and the other added benefit is that it gives us clear-cut stop loss and target levels. Okay, so again, if the initial direction, the next step is up, that will automatically give us a main target level at this pivot and a main stop loss level at this pivot right here, which actually gives us an even further sense of making sense of price. Okay, so since this bias analysis told us that the next step will be up, let's say we buy at this point right here with the stop loss at this level and this main target right here. Okay, and as price moves along in time, we then start using lower confirmations. So let's take a look at that. All right, so lower confirmations uses recent price for analysis. So now if price moved along and is at this point now, we want to use the price just before that in this area right here to now analyze what price will do in the next step from here forward. All right, so we want to use lower confirmations to confirm the direction that the bias told us initially. Okay, and let's say these lower confirmations confirmed from this area right here also confirm that the next step of price from here forward is still up. Well, in that case, we're going to hold on to that buy position. Okay, so in this way, as new price is shown to us, we constantly want to analyze that new price action to determine the next step of the market. So in other words, we're always staying one step ahead of the market. Okay, so now let's go on to current price. Okay, so after we use the lower confirmation to confirm the next step, from that point on, we want to start using current price analysis to continually know the next step of the market. And again, that's in order to stay one step ahead of the market at all times. Okay, so let's say price did reach this level right here, just shy of that main target level right here. However, at this point, let's say current price analysis told us that the next step is actually down now. Now, in that case, we want to eliminate that buy position and moreover, enter a sell position while reversing the risk reward parameters. So now that we're taking a sell position, we want to make the main target at this level and the main stop loss at this level right here. Now you may be wondering, why do we have to eliminate that buy position just because the next step is predicted to be down? Now you want to recall the earlier lessons where I explained the basic price action concepts, where it states current price is more valuable than past price in terms of the analysis process. Okay, so in other words, current price analysis can override past price analysis. Well, the other way is never true. Past price can never override current price. And again, it's because it's more valuable or has more weight in the analysis process. Okay, and if you have further questions about that, just let me know, guys. Okay, so after we sell due to this current price override, let me show you how we will manage this trade. Okay, so like in the last slide, when price was right here and we sold, as price goes towards this main target, which is at this level right here, and until it reaches that target, we constantly want to analyze current price to constantly know the next step of the market. And that's until the main target is reached, right at this level right here. Okay, so here are the key takeaways. Number one, since the nature of the market makes it very hard to predict what it will do in the long term, the price action trader only attempts to predict the market's next move and does that on a consistent basis. Now that said, if you watch my forecasts, there's times when I extend a portion of my position beyond the main target point for the possibility that price may continue going in that direction. But just remember, these extensions are done under the understanding of the nature of the market, and thus are only done after the majority of profits are locked in. Okay, number two, remember, all we're attempting to do as price action traders is to constantly read the next step of the market and make trading decisions accordingly. Now I know it could be daunting to not be able to just take a trade and leave it running, but you want to remember the basic price action rule that states, the further out in time we try to predict, the higher the unpredictable degree. And so in other words, if we're taking positions and leaving it to run, we're essentially gambling. And this gambling mentality is what stops the growth of a trader, giving them a lazy and get something for nothing stance toward trading, which will likely end up with mediocre profits at best. Okay, so if you're serious about trading, accept the true nature of the markets and put in the work required to make substantial profits in your trading. Okay, so that's it for this lesson. If you have any questions, let me know, guys. And I hope you guys have a great day. Thanks for watching. Goodbye.